Hi, everybody. My name's Sam Chaplin here for your quarterly market update. Today is March 16th, 2026. We're coming to you a little later this quarter, given recent events. Want to make sure we keep everybody up to date. Joined as always by our founder and president, Jim Bradley.
I'll throw in that this is actually our second time through with this. Just over a week ago, we reported much of the same content, and there were technical issues with our audio. So this is coming to you a little bit later, but frankly, without a whole lot of a change in content. So some things stay the same, I guess.
Yeah. All right. With that, we'll start with take two. Jump right in here with the headlines from the last quarter. Do a little bit of a lightning round with everything that's been going on. Started off the quarter in January, broad rally, hitting new highs for the S&P 500. Again, really broad rally, small caps, lots of sectors, not just the AI-driven rally we had seen over the past year. So that signaled that a lot of hope around the broad economy, not just the AI theme in general, and that's what we're hoping to see. Also good news in January was Kevin Warsh being nominated as the Fed chair. This was seen as a pretty safe pick by the Trump administration to nominate him. Concerns around whether Trump would put somebody in there who would lower interest rates, whether it's the right decision or not, have faded. So Kevin Warsh does have some credibility to fight inflation and maintain the independence of the Fed. Gold and energy also led as safe haven assets, and some tensions began to build in the Middle East. February, we saw a little bit of a rotation again. Much of last year was built around the AI theme, all these Mag 7 disruptors. And then in February, investors started to ask, who are we disrupting exactly? So software stocks were a big target of, will they continue to hold their margins and their moats as AI takes hold and could potentially write its own software? So seeing some rotations there. Supreme Court also struck down the reciprocal tariffs in February, which were initiated on Liberation Day last April. So those were the tariffs that were kind of a smattering across the globe. No real rhyme or reason to them. Supreme Court struck that down, saying you cannot do that. Trump responded using some different powers to implement a 10% across the board tariff. There has been some threats to up that to 15. So net, that is a lower tariff rate on average than we were seeing a month ago. So that was positive for stocks, but also continued uncertainty around how those policies will take hold going forward and for how long. Also had a hot producer price index report in February showing a little bit more inflation than we'd hoped for on the producer side, likely keeping the Fed on hold. And then all of this was disrupted by the U.S.-Israel war in Iran, Operation Epic Fury, beginning at the end of February and carrying on now into its 70th day. So that is where we'll be spending most of our time today. But before we get into that, always good to remember these are headlines, but the markets are really only interpreting headlines as far as how they will affect the economy as a whole. So before we talk around the war in Iran, we're going to talk a little bit about the economy as we are entering this.
Yeah, we'll spend plenty of time in the headlines, but before we dive into the conflict that's front page, let's just take a quick step back and look at if you watch this production on a quarterly basis, you'll be familiar with this economic scorecard that we frequently use. It measures 12 indicators that we look at to really determine whether we're heading into any kind of recessionary crisis. And the key message from this slide is that the underlying economy was healthy before the war started. Recession risk was low. 8 out of 10 of the indicators that we track were still flashing expansion. There are a couple that were missing because of the still going on partial government shutdown. And this matters because going into something disruptive, the economy did have a bit of a buffer, not only from these technical indicators that we look at, but also just situationally. The first quarter of the year is tax refund time, tends to be a little bit of a boost to the economy. And this year, potentially even a greater degree because there's about a 10% plus increase to what people are getting back in their taxes. So going into this before the conflict, we looked at this as potentially being a actually relatively robust quarter for the economy. And so we're not entering this shock. We're not entering this geopolitical shock from a position of weakness. And the real question ends up being whether the oil shock and all this geopolitical uncertainty erode this buffer that we've got that we're riding on. And if so, how quickly? And so we'll come back to that again when we start to take a look at inflation. But one of the first and most important slides that I'm going to give us is, since we're talking about war, since we're talking about geopolitical disruption, what has that meant historically for long-term investors? And it shows that the S&P, if we want to use the S&P 500 as a kind of a proxy here, the drawdown and recovery pattern kind of shows a little bit of a theme here. Not 100% with certainty, but if we look back 80 years on every major military conflict since Bar Harbor, there's three things that jump out. First, the sell-offs on a average basis tend to be kind of short. On average, if we look at all of those conflicts, the initial drop is around 10.5%. And the trough, the bottom of the sell-off, usually occurs on average in under 6 weeks. Secondly, as is typically the case, recovery tends to beat fear. 6 of the 8 conflicts saw markets higher 12 months later. And those on average out of the 8 conflicts, there's about 17.7% upside after the course of a year in the recovery cases. 2 exceptions you'll note here on 1 year results are the 9/11 attacks and the Ukraine invasion. But helpful to understand context there, the 9/11 attacks happened around the same time as a major economic and market disruption, which was the dot-com bubble collapsing. The Ukraine invasion happened right about the time of really seismic shift in inflation and big, long Fed campaign of increasing interest rates. But third, and most importantly, just generally in all of these, investors that panicked generally had to buy in at a higher level later on. So calm when it comes to your portfolio consistently is the way to go about it. And if you're waiting for calm in the future, you're going to probably pay a higher price for it. So yeah, I'll kind of leave that at that point, and let Sam kind of dive a little bit deeper into kind of the specifics about this conflict that we're talking about.
Thanks, Jim. As you mentioned there, a lot of times these returns have more to do with the underlying economy than they do with the war themselves. And by the time you feel calm, it's likely that the markets are already going to have recovered. As we look at the scope of the conflict here, there's one distinction I want to make that is it is a tough one and causes to me some conflict, which is that anytime there is trouble happening in the world, everybody in the investment community jumps out to tell you it's going to be all right and don't worry about it pretty much. And I think that often comes off as disingenuous and self-serving. So I do want to make sure that we're being clear here that we're market analysts. We're not military analysts or political analysts. And on the human level, we share a lot of those concerns. But the point we're trying to make here is that markets historically have not been the best place to put out those concerns. And while the concerns are completely valid, we want to stop anybody from potentially shooting themselves in the foot here by making a knee-jerk reaction in a market that hasn't historically done well to sell prior to these types of conflicts. So when we're looking at the scope of the conflict here, full-blown regional conflict at this point, something like 20 countries have bombed or been bombed so far in this conflict. It has been widening faster than we had hoped and had expected into areas, active fronts in Iran, Israel, Lebanon, and beyond just the Israel-Iran conflict that you may have been hearing a lot about. So when we get into a broader conflict here, we're worried about those Gulf states, which is an area that supplies a lot of oil to the globe. So about 10 million barrels of oil go through the Strait of Hormuz every day. That does come out to be about 20%, 21% of the global oil supply. So that has come to a complete halt as of March 2nd. Almost no ships going through the Strait of Hormuz. So a lot of disruption here. We're looking at where that oil tends to come from and go to. Most of it from Saudi Arabia, going to Asia and China, as well as Iraq to Asia and Europe, UAE, Kuwait, Iran, all in there. Mostly shipping the oil east. But oil is a global market, so just because that oil is not coming to the U.S. does not mean that we're not going to feel the pain of it. On the next slide here, we're going to look at the oil reaction by conflict and how it has changed in past conflicts. Again, going back 80 years, as Jim mentioned, much more of a mixed picture here, whether the conflict is linked to oil itself and the oil infrastructure or not. Duration is certainly the key variable that we'll be watching. The Strait of Hormuz being closed is awful for the global oil supply, but can be reversed really quickly. They are able to reopen it. At this time, the Trump administration is trying to pull together a coalition of different countries to try to support, bring the navies in to support reopening the Strait of Hormuz. We have not seen that gain any traction yet, but that is a direction that could bring these oil prices back down. We have also seen gas prices up 24% over the past few weeks. So again, just because oil isn't coming to the U.S. doesn't mean the consumer isn't going to feel it. We'll look in a minute at who is the major winners and losers coming out of this conflict as it pertains to oil prices. But the spike is definitely real. This is unprecedented. IEA is calling it the worst energy supply disruption in history. So I'm not going to sugarcoat it there, but we'll also remind everybody that markets have weathered a lot of unprecedented events in the past. And in fact, all of them over the past couple hundred years. So that is no reason in itself to sell. We do have some other protections in place that make this oil spike a little less scary for the U.S. and past ones, particularly the fact that the U.S. is now a net exporter of oil is one of those big protections. But before we dig too far into that, I'm going to hand it over to JB to talk about inflation, because oil prices do tend to work their way into price the goods and services that need to be imported and exported around the world. So inflation is going to be one of the big factors we're looking at.
Sure, inflation's going to come from a couple of spots, but certainly oil is front and center in our minds as to what could conceivably drive prices in the short term. And this table puts the oil spike that we're seeing in kind of historical context. What we're looking at is the oil price reaction to every major conflict, again, since Pearl Harbor. And Brent C crude, we look at a couple of measures, Brent C crude and the New York Merc crude had both surged. Brent has surged from a baseline of about $72 pre-war to, looking on my data screen, it's over $100 right now in just a short period of time, just a few weeks, which is a big spike. For context, in the Gulf War in 1990, we saw a 75% 30-day spike, but that actually fully reversed within a year. 1993 was not so pleasant. That was an OPEC oil embargo that saw oil prices rise more than twice, 120% in the first month, and over 270% over the following year. So really huge outsized movement there, and created some significant long-term disruption in the economy. What makes this year different from most of the conflicts on the table is that, as Sam points out, as the Gulf of Hormuz or the Strait of Hormuz, the closure there is a real physical supply disruption. It's why the IEA is calling it the largest supply disruption in oil market history. The key question, though, becomes degree of disruption and duration of disruption. How much does it get cut off, and for how long? So if Hormuz reopens within weeks, with kind of the Gulf War of 1990 being kind of an example of that, the spike tends to reverse historically. If it drags on for months, then we go back and we have to compare against something like 1973, which is scarier. And that's a very different outcome. But, really, we're looking at a situation that's pretty different from 1973 when you look at, where we are. And we'll get to something that Sam was alluding to earlier, as far as energy independence, quote unquote, as a country. But slide this into what that looks like for inflation. And obviously, inflation is directly relevant to Fed watchers out there as to what they're going to do next. And the historical pattern is clear. Obviously, oil-linked wars hit inflation the hardest. Big deal in 1973, as I was talking about. The 1979 Iran Revolution took inflation up to 13.5%. Wars without a direct energy disruption like Vietnam or the Iraq War or Suez Canal conflict in 1956 or 9/11, those had much higher inflation, or much milder inflation impacts than some of the more systematic ones. In 2026, obviously, is shaping up to be an oil-linked war. Brent up 45%. Fertilizer prices are up just at the wrong time when we talk about people starting to get to the planting season. But what's most difficult about this is we're also seeing simultaneous signs of economic weakness. The Michigan consumer sentiment number fell down to 55.5, which is a pretty significant decrease from where we were earlier. February payrolls were projected to be a positive 50,000 gain and turned into a loss instead of 92,000, far below expected wages. And unemployment rose to 4.4%. And with inflation expectations at 3.4%, that's kind of this, I call it the S word cocktail. This is stagflation potentially rearing its ugly head, which is not something that puts the Fed in an enviable position. If they hike to fight the inflation, then they're risking a deeper downturn in the economy. If they cut rates to cushiony growth, that could untether inflation expectations. So right now, I guess if we're looking for a silver lining, it's the fact that we didn't start off out of the gate with a high level of inflation at roughly 3%. It's in line with historical norms, a little bit higher than what the Fed would like to see, but still much better than we were in just a few years ago with over 8% inflation rates. So it's going to be interesting to watch how the Fed approaches this, and I'll say it's probably going to be conservatively and cautiously. If we go to the next slide, it's important to point out, an oil spike on its own doesn't impact everybody equally. There's frankly, quote unquote, winners, and those are exporters. Ironically, the biggest winner seems to be, from just a pure exports standpoint, seems to be Russia. And there's talk about significant tens of millions of dollars daily that Russia stands to gain from this particular conflict, not only in the fact that they're an alternative exporter of oil, but also because of the reduction potentially in sanctions against their oil industry, and as the West tries to limit the amount of impact that it has on it. So the biggest loser, if we look at this chart, the biggest red line, that's China, importing 12.1 million barrels per day, more than double India's exposure. And where does China get most of its oil? It gets it through the Straits of Hormuz, which is also potentially something to keep an eye on, because who has an incentive more than China to try to get that strait reopened and to restore the free flow of oil through it? Interestingly enough, that would be China. We look at where the U.S. stands, a modest exporter. So hypothetically, that could put us in a more neutral position from a standpoint of what our oil prices end up being as a result of something like this. What we've seen is something very different so far, but it also lends some hope to, if this does get resolved in a quicker time period, that we might have a better opportunity to get back down to the baselines that we saw beforehand. There's actually really a range of scenarios that could come out of this, and I'm going to turn it over to Sam to cover some of those potential outcomes.
Great. Yeah, these are some scenarios that are built off some Bloomberg economic scenarios, and we've updated based on past events. So the biggest factors we're going to be watching here, as Jim has alluded to, is the timeline of the disruption and the amount of damage that is done to energy infrastructure. So the timeline of the disruption largely linked to the Strait of Hormuz and the oil that is not getting through there every day. The one upside to that is that can be reversed real quickly, and the oil could start shipping back through there. I think I saw that over the past couple weeks, there's been about 70 tankers that have made it through the Strait of Hormuz, down from about 1,200 in the same period last year. So that is a lot of oil that is not making it to market, putting a strain on the global economy. In this first scenario here, we're looking at intensified attacks on energy. When we were recording this a couple weeks ago, that wasn't a big concern at the moment. Both Iran and U.S. Israel had largely spared energy infrastructure. We are starting to see that deteriorate a bit and seeing more attacks on energy infrastructure. The obvious downside to that is that it's not so easy to flip the switch and turn energy infrastructure back on. That can create much longer durations of disruption and therefore more strain on the oil supply and higher prices. So that's what I would say we are in that scenario at the moment. Oil price around that, within that scenario, would be around $108, which is a little bit above where we are now. A helpful rule of thumb for everybody wondering how this affects them at home is that every $10 oil goes up translates into about 25 cents more at the gas pump. So we've seen a lot of that price pressure baked in now, but there's typically about a month lag between oil prices going up and gas prices going up. Now, that doesn't mean we can't de-escalate. I think there are some hopes for de-escalation. We have seen the Trump administration, I think, looking for an off-ramp to this war before it impacts inflation and markets too much. So if we were to see a little bit of a scaling back there, limited attacks on energy could bring us down to about $80. If we do see some de-escalation there, a ceasefire completely could bring us back down to around $65, which is where we were prior to the conflict beginning. And then if the Islamic Republic collapsed, there could be some long-term geopolitical implications there, but would likely push oil prices right back down to around that 65 level. So I'd say right now we are intensifying attacks on energy, hoping to bring that to an end, and we can start to see oil prices rebound a little bit. We're actually seeing some signs of that today. I think there's a lot of thoughts that the Trump administration doesn't want to inflict a ton of pain on consumers and companies and cause an inflation spike right before the midterms. So I think they are looking for an off-ramp there, and I think we're all hoping that they find it. So just to recap there, key market variables: disruption duration, infrastructure damage, and the escalation conflict of the scope. If we were to see direct attacks with other countries around there, perhaps Iraq and Lebanon, we could see more infrastructure damage and more damage to the oil supply, which would push prices higher. We have been activating a lot of the buffers, largest release of strategic reserves in history. So that has brought prices down a little bit, but markets are indicating that in itself is not likely to be enough. Jin had mentioned a couple of good things. With the starting conditions are still better than we were in beginning the Ukraine conflict, and actually, thinking back, we're having a lot of the same conversations and fears around stagflation, and we're able to avoid those outcomes. And I think we're all hoping that we will again. But that's the things that we'll be watching. We're here if you have questions and you want to reach out. We'll be providing more updates as things progress, and as we hopefully move towards a peaceful resolution here.
Stay tuned, and we'll see you next quarter.
See you next quarter. Thank you.